If you just retired and aren't using low income years to set up your future taxes, you might actually be making a huge mistake. Because the real goal isn't just lower taxes today, it's lower taxes over your lifetime, and that's where understanding how to use your tax brackets can become incredibly powerful. But which one is best for you, and is it the same for everyone? To explore that in this video, I'm going to highlight the most common brackets retirees face and walk you through an example of a retired couple trying to make this decision with some real numbers. But first, I'm Curtis Crossland of Suttle Crossland Wealth Advisors, and the purpose of this channel is to discuss financial topics and ultimately help people build more tax-efficient retirements. So let's get into it. Now, the first thing we need to do is have a quick crash course on tax brackets and how it works. The United States uses what's called a progressive tax system, which means portions of your income are taxed at different rates. Where it gets tricky is understanding that just because you might fall into a high bracket does not mean every dollar you made is taxed at that level. Think of tax brackets like buckets. You fill the lowest bucket first, then the next, and so on. And this is also where you'll hear the term marginal tax bracket and where it comes into play. A marginal tax bracket defines the percentage of tax you pay on your highest dollar of taxable income. Check out this chart so you can see what I mean. Notice how the tax rate you see on the left side has a range of income aligned with it. For a married couple in 2026, their 22% marginal tax bracket starts when their taxable income is greater than $100,801 and ends when their taxable income hits $211,400. Any taxable income they have below that or above that is going to be taxed at those different rates. What's also interesting about this is how the tax brackets can differ depending on your filing status. If a married filing joint couple had only $99,000 of taxable income, you can see that they'd actually fall into the 12% marginal bracket. But a single person with $99,000 of taxable income nearly fills up the 22% marginal tax bracket. Have you ever stopped and wondered what would happen to me in 10 years if I filled up a certain bracket today? This can be a difficult question to answer. Nobody knows what the future is going to look like, but thankfully we're not living in the dark ages and we can use technology to at least help us get a better projection on the path forward. And the surprising part, sometimes intentionally filling up a tax bracket today can help you avoid much higher taxes later. So let's jump into an example and see if we can find a tax sweet spot, at least for these people. So here for our example today, we have Earl and we have Pearl. And let's take a look at some of the numbers to get familiar with their situation. We can see that they are both age 63. They are currently retired, and we're going to say that they have a life expectancy that goes to age 90. If we jump over here, we can see that they have a total net worth of just over $3 million, and that's made up of some cash in the bank with a checking and savings account. There is a joint taxable brokerage, which has just under about $500,000. And then we see 2 IRAs for them, totaling right about $1.6, $1.7 million. Primary home is paid off, and they do not have any debt on anything at the moment. So the financial goals in and through retirement are pretty straightforward. Pretty plain vanilla. They basically don't want to run out of money, and they want to try to spend about $8,000 per month when you include everything. We're going to add a little bit of extra costs in here for health-related issues and a little bit of long-term care cost concern, but they might look at the $8,000 and saying, well, hey, we intend for that to kind of encompass all of this. Over on the income, you'll notice there's no pensions. We have basically just the Social Security listed here. There's no rents or royalties. They're basically just going to retire with the portfolio that they have and eventually the Social Security that kicks in as well. Now, I do want to pause here at the Social Security just for a minute. There's no end to the number of Social Security videos that you can find on YouTube. You know, every possible permutation of when and how to take it has been discussed, and there's so many different opinions that this part can get confusing. I've done videos myself that cover this topic. You can check those out if you feel so inclined, but here's a point that I want to make. When you take Social Security, it's more than just the decision on how much you can make per month. It needs to be a decision made on the basis of your situation and no one else's. You know, what are your goals? What are your health situations? You know, what are your family needs? So please take everything a YouTuber would say with a grain of salt, anyone else and myself included. Do a proper analysis for yourself, make an informed decision on the basis of your life. Now, with that said, I do want to highlight what I think are 3 very important considerations that somebody would want to make when they're trying to make a decision on this. Number 1, what is the survivorship payout from the highest earning spouse? And this is a big deal. Unless you basically die together, there's a good chance that there could be some time from when one spouse passes away before the second one does. And if this is the case, a surviving spouse gets the higher of the two Social Security payouts. So if somebody has a high benefit, like this example, we can see, Earl over here has got a monthly benefit estimate of $3,080. Well, if he's the higher earning Social Security income, he needs to consider, all right, what is the survivorship angle to Pearl should something happen to me? What if he dies at 64? And so this can be a big deal. If one spouse passes away early, the surviving spouse is going to get the higher of the two benefit amounts. The second thing that I think somebody would want to consider, what age does give you the best projected lifetime payout? For Earl and Pearl, if I jump over here and I take a look at, okay, what is the optimal strategy of how are they going to get the most that they're going to be paid out? We can see that this is basically telling us they want to have that benefit start at age 70, but this is in a vacuum. The only thing that's being looked at is what is that maximum amount being paid? Now, life expectancy factors this as well. So, the question that comes up a lot is, all right, well, if I delay, where is the age of break even? Well, in their case, it's age 80. So if they both live to 80 plus, then the most that they will earn in their lifetime, looking at it just by itself on the Social Security, would be if they both take it at age 70. And then the third thing I would say to include in any decision-making process that you have, and certainly there's going to be more variables, but at least the third here, how does the timing of starting this affect your tax planning strategy? Technically, Earl and Pearl, they're 63. They could have started it 1 year ago at age 62 and gotten the earliest payout possible. They can also delay all the way till 70. Then every year that they delay, they could see a higher payout based on that age. Now, how does that affect tax strategy? Well, there's a chance that some or most of your Social Security benefit could end up being counted as income that is taxable to you. I did do a video on this on looking at how much of your Social Security actually does get taxed. You can check that out if you're so inclined, or if you need help falling asleep, put it on, it'll knock you right out. But delaying Social Security could also be a decision of, okay, well, if I don't take it at 63, what if I take it at 67? What if I take it at 70? What do I do with those years that I'm then in a lower income position? Now, because this couple, Earl and Pearl, they are in a strong position regardless of their age. And we can see that if I jump back over here and we take just a quick look at their Monte Carlo, we do see that they have a very high probability of success. They have a very large median terminal balance showing up here in the projection. Their goal is to focus on the optimization. So they are intentionally taking it as late as they can. And so basically over here, what we're saying on the Social Security is they're both going to delay until age 70. And again, we saw that their break-even age is age 80, and they thankfully have no life-altering issues currently. And because of this, it does also project to have the highest lifetime benefit payout, which kills two birds with one stone in their situation. Now, additionally, by delaying, they're also going to find out that they have a few more years of lower income, years that may end up being very beneficial in terms of the potential for other strategic income recognition. Now, they could do that either by use of the IRA assets. They're going to have to pay for that $8,000 a month somehow. It's got to come from somewhere. They don't have unlimited bank savings, or could come through Roth conversion. Now, they don't want to work anymore, so it's not going to come from part-time job consulting. Neither one of them really has a desire to be a landlord, so there's not going to be any rents or royalties. But this is just one way to go with Social Security, and this is just what I think could end up being a benefit to their situation. But I really want to know what you guys think. Let me know down in the comments. When do you plan on taking Social Security? What is your thought process? What are other major considerations that need to be included that you feel somebody else seeing this video or even your comments would need to know? Please share your thoughts. And now that we know a little bit about their asset situation, their income situation, their retirement situation, and what their goals are, let's take a look at their actual tax projections and see if we can find anything out from there. Right out of the gate, we can actually see that in their current situation, no Social Security, no other real income other than what's coming off of their portfolio, they're in that 10% federal tax bracket. But as time goes on, you'll notice there's going to come a point at which that 10% actually jumps. Now we're at 12% age 74. Now we're 22% age 75. And then we can see it actually jumps up into the 24% once they hit right around age 79, age 80. And we see that it continues on pretty much until they hit near end of life. Now, like it or not, if they do nothing, they are going to experience these different tax brackets at some phase of their life, from now at age 63 up until they pass away. And you might wonder to yourself, all right, well, what is the cause of this big jump? Well, it's going to be when they eventually have to start taking required minimum distributions at age 75. Required minimum distributions are an amount that will have to be deducted from their pre-tax or IRA accounts every year, and the basis of that is determined using the IRS's formula. Now, if you're like me, you might look at this and say, well, hey, this 10% is great, but I really do not like this spike here, especially if you're telling me these are things that I'm going to have to do and I don't have a whole lot of choices. What can I do maybe in these years here or this gap here? Is there a way to even this out essentially? And so this couple really is in a strong position. They have strong income, they have strong projections, and it's looking like they have some really interesting tax planning opportunities from age 63, essentially to about age 73, 74. So this is the moment where they can start to use those low income years to set themselves up for their lowest lifetime taxes. Like I said at the start of the video, them enjoying this 10% is great, but what if this actually costs them more in the long run? That could end up being a big mistake. Let's explore what happens when they start to fill up their respective tax brackets. And now, what do I mean by fill up a tax bracket? Well, this would be purposefully recognizing enough income to exhaust the amount of money that is taxed at a particular rate. So going back to that chart from before, if I wanted to fill up the 24% tax bracket, I'd need to make sure my taxable income hit the last dollar within that range as opposed to the first dollar. This can be done in multiple ways, but in Earl and Pearl's situation, their opportunity is really going to come from using the IRA account, or really what we're going to be looking at is converting. And so we're basically going to be looking at converting it over the next several years while they're in these lower brackets. Now, some of you might be wondering, why on earth would you do that? Just take the 10%. I have no idea what the future is going to look like. You know, the 12, 22, these brackets could change. Okay, I understand that, but let's take a look at some of these numbers once they start to hit that RMD age. So if we come over here and we actually look at the tax detail, again, you might look at this and say, wow, I'd love to have, you know, this 10% bracket as the tippy top, owing nothing for all these years. But look at age 75. Look at what happens in terms of the adjusted taxable income. Their adjusted gross income is also going to go way up. Depending on what state they live in, this could also have a huge impact if they have state income tax. But this doesn't really relent. The only way these numbers go down is if their portfolio takes a massive hit, or if they distribute everything, or a massive portion of their portfolio in any particular year. If the portfolio maintains its value or goes up in value over time, the idea is each subsequent year when they take that required minimum, they're going to see a higher amount of income that they have to take. There's a higher amount of required minimum that's going to come out each and every year. So at a certain point, especially if they live well into their 80s, maybe even 90s, these numbers start to get bonkers. So imagine you're 82, you have $400,000 of income, not because you're working a job or you have, 10 rentals, but because you have money in an IRA account and the IRS says you now have to take a portion of that out so we can tax you. Imagine finding yourself in that 24% bracket, your tax bills, estimated federally at $80,000+. What else do you think happens to you? Well, even though things like Medicare's IRMA indexes over time, there's a really good chance that the amount of adjusted gross income they're experiencing in this is going to push them into much higher IRMA tiers. We can actually see that if we come look at the modified adjusted gross income on the left column here, and you look at that tied to the Medicare estimate cost for both Earl and for Pearl. So as their modified adjusted gross income climbs and starts to go from that required minimum above the thresholds of the tiers of IRMA, and there's several of them, they start to see an increase in the costs of their Medicare. And they might say, well, I don't like that. Well, too bad. That is the nature of what is ahead for every retiree out there. If your income goes up, whether it's by things you are doing in the marketplace, things that you're doing in terms of your employment maybe still, or any other income, you're going to have to potentially deal with the impact of a much higher income, a much higher adjusted gross income, and some of the fallout of that is these surtaxes. So now let's take a look and see what happens if we start to work through some of these different tax brackets, or fill up some of these common tax brackets that people will face in retirement. Typically you'll see a lot of folks somewhere in the 12, 22, 24, even 32% marginal tax bracket, depending on their income. But let's see what happens as we start to fill that up for both Earl and for Pearl. So if we come down here and we say, okay, we're going to use up the 12% bracket, they're going to have expenses and things that possibly means they're going to have to maybe dip into that IRA, but they're going to say, look, we're comfortable converting up to the top of that 12% bracket. What does that do in terms of their federal taxes paid? Well, as we can see, this really starts to kind of smooth, in the green here, starts to smooth out some of that tax payment over their lifetime. But we can see that there is a projected reduction in the total amount of federal taxes paid by doing a Roth conversion or use of the IRA up to that 12% bracket. So one good question is, well, if some is good, is more better? Let's see if we can find a sweet spot, at least looking just at the federal taxes paid. Change this up to 22%. And we can see that there is a further improvement in the amount of projected savings. But now, instead of having a little bit more of a smoother, having a little bit more of a smoother income situation, well, now they've got something that is a little bit more front loaded. And so if they're willing to entertain that strategy, there is the projected potential of a even lower amount of federal taxes paid over the lifetime. Now, some of you might be yelling at your screen right now or thinking, I've missed it. There is a give and a take when it comes to moving into these tax brackets. There are times where you may find that you have no choice. RMD years, as we discussed, might put you in a position where you have no choice. But you might say, why would I willingly choose to go higher, knowing that if I go up into and past the 22% bracket, I could start to trip up some of those surtaxes. And the big one that people will look at, and I've mentioned this multiple times in past videos, is Medicare's IRMAA. If you, as a married couple, push to the top of the 22% bracket, your modified adjusted gross income will likely push you to at least that first tier of Medicare's IRMAA. Now, those numbers can shift every year. They'll index that depending on what inflation has done. But you'll notice here for Earl and Pearl, if they push into that 22% bracket, their Medicare, and there's a 2-year look back on the adjusted gross income for Medicare, but you'll notice that the cost or increase to their Medicare premiums occurs here. And that's because they have that higher modified adjusted gross income for a little while, and then it starts to fall off as the balance of accounts starts to come down. Now, if we were to go even higher, so if back over here, we said, all right, well, 22% looked like it did something good on the federal run. Let's do 24. 24 actually gives us an even better projected lifetime tax savings, but now you'll notice this is a much bigger upfront payment. So they would have to front load their taxes to an even higher degree. This would also come over here and raise their Medicare's IRMAA to a higher degree. Now notice it's just for a few years in their situation, but this is part of the give and the take of looking at using some of these tax brackets. Now, something that is not listed right here, but this has to be consideration, especially for a married couple. Once your modified adjusted gross income goes above $250,000, you are now entering the area where they will do a means test for something called net investment income tax. I've done a video on this topic. So if you're bored or you can't fall asleep, you can go check that one out next. But net investment income tax is an additional surtax when your income gets too high that looks at your investment income and taxes you on the lesser of that or the amount of the adjusted gross income that exceeds the benchmark. So again, for a married couple, that's $250,000 per year. That's something else that has to be considered. But if we are looking again at lowering lifetime projected tax and using up a tax bracket, we would say, okay, well, 22 was great, 12 was great, 24 seems to give us the highest projected federal tax savings right now. What happens if we go even higher because we're curious and we say, well, all right, 24, forget that, let's do 32. Now we see that we're actually starting to come down in terms of that potential benefit. So we're getting to a point of diminishing returns here. So if we really front load the income, we don't save as much in the projection. We're certainly going to have the same issues to face with in terms of Medicare's IRMAA, as well as net investment income tax, but thankfully it's just for a few years here. So what are some practical takeaways from looking and discussing the tax brackets in retirement? Well, first, it's understanding that these exist. You might be the type of person that looks at all this and says, I get a headache. I don't want to deal with this. I need my life to be stress-free. Maybe you go back and maybe you've done your own work in this area and you look at a Monte Carlo and you say, look, I'm doing great. My Monte Carlo's a big number. My assets look like they're just going to grow. I don't want to deal with this. I'm just going to take things as they come. That's fine. But if you're like me, if you look at this and you think, all right, are there opportunities to optimize? Are there things that I can do that could take my income looking like this, maybe I front load, are there things I can do? Or maybe I'm, looking at being in the 22% tax bracket for a while, but the goal is to then be in a lower tax bracket for longer and not be forced to have to take out income with the required minimums, be forced to potentially, pay more in Medicare for more years, or have more net investment income tax, or have a higher amount of provisional income for more years, which means a higher percentage of my Social Security gets taxed for more years. If those type of things bother you, then understanding where these brackets are, understanding what your options are within your own situation is going to be something that you're going to want to do. So do you know your numbers? Do you know where you stand? Is this an analysis that you've done? Have you maybe thought about it, but thought, maybe I don't have the bandwidth to do this, or I don't have the tools, but I'm aware of it and this bothers me? Maybe a video like this could get you thinking a little bit more about what is possible. And the thing about tax planning, especially when you look at this, a simple graph like this, you might look and say, okay, this looks simplistic enough. This is not simple. Tax planning is not static. There's not a point in your life where you get to be done with that unless you have just said, I'm going to take things as they come. Every year, this is something that you would have to assess. There could be changes to tax laws. There could be changes in your life situation. But if nothing else, the big takeaway I'd hope you get from this is that this is worth looking at for yourself, and it's worth understanding, is there a sweet spot for you? And is that sweet spot the same thing that your neighbor is doing, or the same thing that you heard from another YouTube video or some other publication, or the same thing your relative's doing? The big takeaway is that this is going to be a going concern. My hope is that I have shown you enough to at least get you curious about your own situation, and so you can start exploring what could happen or what the potential is within your own tax brackets, and how to start thinking through that so you can assess what you might want to do. Now, what's so interesting about this to me is that if you use someone else's age, someone else's income, essentially someone else's financial life, you might end up with a completely different conclusion on which tax bracket might be a sweet spot for them. Maybe it is just staying in the 10% bracket now, or maybe it's really pushing the limits and going up into the 30s. All of this is to say that there is no magic bullet. There is no one size fits all. There is no do this and not that as a blanket statement. There just can't be. This is too complicated for each person's situation, especially as time marches on. So what is your tax bracket sweet spot? Do you even know it? Do you worry about what you might pay in the future? Do you worry about what you might leave to your kids and the tax implications to them? Let me know down in the comments what you think and what else you want to figure out in regards to your own tax planning. Bottom line is, everyone needs to analyze and assess their own situation to determine if they have a particular tax planning strategy that aligns with their goals and has the potential to either save them in lifetime taxes or provide a net tax benefit to them, their retirement, or their legacy. And if this is a topic that speaks to you, or you're tired of trying to figure this out on your own, be sure to check out our links. And if you learned anything or got anything out of this video, I'd really appreciate a subscribe. Once more, I'm Curtis Crossland, and if you want to see how we help folks build a more tax-focused and efficient retirement, be sure to check us out at SuttleCrossland.com and subscribe for future videos.